new tradition we have here. We're going to open with the Pledge of Allegiance and prayer. Okay. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Let's bow our heads. Oh, Heavenly Father, we want to thank you for all the blessings you bestow on us each and every day. Please be with the Christian world as we've lost a pope, and they work in the next couple of weeks to select a new leader in the Christian faith there. Please watch all over our military and everyone on this committee as we try to do good in this state and try to lead our state forward. In Jesus Christ's name we pray. Amen.
Amen. You should have got in there good stock returns.
Yeah, well, that's true. I haven't checked it. Is it bad
We
today?
have. Okay. All right. Good afternoon and welcome, everyone. If I'll remind you, I'd like to remind myself, turn off your cell phone or put it on silent. And again, welcome to today's meeting. Madam Clerk, would you please call the roll?
Senator Berg, Senator Elkins, Senator Funky Fromeyer, Senator McDaniel, Senator Neal, Senator Nemus,
Present.
Senator Wilson, Representative Bojanowski, Representative Camuel,
Here.
Representative Duval,
Here.
Representative Fleming, Representative Johnson,
Here.
Representative Petrie, Representative Tipton,
Here.
Auditor Ball,
Proxy Alex McGarrett on behalf of Auditor Ball.
John Hicks,
Here.
Victor Maddox, Sharon Mattingly, Representative Hale, Senator Higdon,
Here.
Representative Thomas.
Present.
We do have a quorum duly constituted to do business. Entertain a motion for approval of the minutes. So moved. We have a motion and a second. All in favor signify by saying aye. Aye. Opposed? Motion carries. We do have a special guest today. I'd like for him to stand up and take a bow. Dave Eager, welcome back. And it's good to have you here today. How's retirement? I thought you were going to say you highly recommended it. Okay. First on the agenda today, Beau Cracraft, Executive Director, Judicial Form Retirement System. Beau, we all know you, but state your name for the record. The floor is yours.
For sure. Good afternoon. My name is Beau Cracraft, and I'm the Executive Director over at Judicial Form Retirement System. It's good to be here this morning. I appreciate your all's time and the opportunity to share. I've been asked real quickly just to provide a quarterly update with regards to investment performance and asset allocation through the end of the most recent quarter, as well as some summary cash flow data and a couple brief comments with regards to the 2025 regular session. And so we'll jump right into that. On slide 2, begin with a review of investment performance. And again, this reflects information through the end of March. Now, I know we all know in this room a lot has happened since the end of 2024. Most notably, there's been a ton of volatility within the equity markets, both here in the U.S., but also globally. After 6 consecutive quarters of positive results, and the S&P 500 declined just over 4% to start 2025. And our Board of Trustees just met last week, and Bear Trust provided a quarterly update. As of last week, the S&P year-to-date 2025 was down just around 8%. So it's continued to drop a bit since the end of this data that you're looking at here. Now, as it relates to our 2 plans, you can see that at least initially, the plans have weathered this initial storm pretty well. If you look at that first column, just right of the market value figures, fiscal year to date 2025, the plans are up just over 11% versus an index return of 4.5%. I'll tell you that almost all of that relative outperformance occurred in the first quarter of 2025. If you look at just the first 6 months, we were fairly flat or benchmark-like. But in this 3 month period to begin 2025, we were the portfolio really preserved capital in a declining market. And historically speaking, Baird Trust, who is our sole investment provider, they've tended to perform pretty well in sharp or dramatic drawdowns, and they try to keep pace kind of when markets are roaring. And so this is another example of a situation like that. Just to speak to a little bit, the team's been underweight information technology, specifically the group that you all probably hear called the Magnificent Seven. They've been underweight for about 2 years, and this has served to kind of drag on the performance. And it's one of the reasons why they've, in these strong equity markets, we've kept pace, but we haven't really outperformed. But during this 3 month period, the Magnificent Seven really struggled, and so that underweight served to really add a ton of value. Interestingly enough, in March, they added to a couple of those names and also introduced a new holding, which is one of the Magnificent Seven, Amazon. Longer term, as you look to the right of this slide, you can see, longer term. I always like to look at the 5-year, given the actuarial impact and the fact that we're smoothing assets over 5-year periods. And then I would I would be remiss if I didn't draw your attention to the 20 and 30-year results and just take a minute just to highlight how profitable and the partnership with Baird Trust, who was formerly known as Hilliard Lyons, has been for these two plans. I've said it before, our model is unique. It's not something that the other plans can do given the number of the size of assets and the size of their portfolios. But to look out at a 20 and 30 year 9.5% compounded return, it's really something to acknowledge. And I just think it's also neat when you think that this group of investors who has had this money for 30 years, they operate and live in Louisville, Kentucky, and so it's a Kentucky-based organization as well. Moving to slide 3 is just a quick snapshot of asset allocation. I'll just remind you, our portfolios are targeted. They target a 70% U.S. equity, 30% fixed income, which is benchmarked to the intermediate government credit. You can see, and this has kind of been a similar story the last couple of quarters. We've tried to keep the equity target pretty close to 70. Baird's kind of consciously and consistently rebalanced when the portfolio has reached about 75% equity. And so over the course of 23 and 24, they rebalanced the portfolio several times, and most notably 5 times alone in the 2024 calendar year. But the goal is to keep that somewhere around 70. On the fixed income side, you can see that we're slightly below that 30% target, but most of that underweight is currently being held in cash. And this is solely for the purposes of cash flow, which you'll see here when we get to the next page. Honestly, we've taken opportunity with some of these rebalances just to kind of hold some cash back. We've invested it overnight, and that helps us manage between rebalances and bond maturities, our cash flow. Speaking of cash flow, that's slide 4. Again, this is a 9-month period, fiscal year to date, 2025, as compared to the same period 1 year ago. And as discussed several times before this committee, given the plan's funding level and our most recent budget request with regards to contributions on the employer side, we do expect these plans to experience some negative cash flow, and you can see that reflected in that gray shaded row, just over halfway down the slide. A couple of really just quick things I'll point out. On the JRP side, you can see that inflows declined quite a bit. Again, that's most notably evident in the employer contribution rate. In the current budget biennium, the request went significantly down from 2024, and so that's more than all of the decline in inflows. Our income has increased a little bit to offset that. And then on the outflow side, really the only notable thing, benefit payments look like they've declined year over year. It's a little misleading, as 2024, we had a handful of judges who took refunds from the post-2014 plan. And so we had some one-time refunds that kind of make that number look like it's higher. If you back those refunds out, there's a slight increase in benefit payments, which is kind of expected. On the LRP side, just wanted to remind everyone that that fund has not received any budget dollars for the past several years, and so you can see that reflected in the second row there with regards to employer contributions. From an outflow standpoint, benefits grew slightly, a couple new retirees, but nothing really dramatic with regards to that either. In the end, again, we're negatively cash flowing, but given the recent results on the investment side, when you lump in the realized, unrealized gains, then you see a change in net position that's positive. I spoke with our retired judges on Friday afternoon, and it was the third time I had spoke to them, and the third time I had told them I don't expect assets to keep growing because I didn't expect equity markets to continue to grow 20 and 25%. But again, that's been the case here recently. And so it seems like we're growing assets, but that's a little outside the norm, and it's all driven by the realized, unrealized gains. So if 2025 continues, you're going to probably see that unrealized gain come down, and then we would see the asset base drop as well. The last slide I have is with regards to a legislative update, and there really was only one bill that directly impacted our plans, and that was Senate Bill 183. This bill was related to proxy voting. It's somewhat of a follow-up to House Bill 236, which passed during the 2023 session. This bill would it further define some key terms such as shareholder-sponsored proposal and economic analysis, but it effectively would require either us or Baird Trust. Baird Trust acts as our sole investment provider, and so they do execute trades on our behalf. If there was a situation where they were to vote in opposition of management, they would be required to produce an economic analysis to kind of justify their reason and to kind of have proof that it was in the sole interest of the members and beneficiaries. When this bill was introduced, I had a couple conversations with our equity team at Baird. They reviewed the bill. We don't expect it to have a real significant or a real material impact for a couple of reasons. One, our portfolio currently has 26 names total, and so the number of votes that we're having to manage and address on a calendar basis is pretty manageable compared to the other plans, which may own large index funds and have hundreds of votes. The other thing that I would just note is that at its core, Baird Trust investment style, it tends to avoid these type of situations. At their core, they will state over and over that they want to take a long-term business owner mentality. Oftentimes they say, when they buy a couple shares of Amazon like they did a few weeks ago, they believe they own the entire company, even though they don't. But that's the mindset they want to have. And so interestingly enough, when we were going through the quarterly results of March, 6 of their 7 top contributors in the portfolio, they had owned 20 years or more. And one of those 7, they had owned almost 9 years. And so they're holding these companies for a long term. And so not only that, if you're trying to invest in something for a long term, you're really investing in the people who are leading it. And so management team and confidence in management is really one of their 3 key factors, in addition to the business model and also the valuation. And so they're oftentimes investing in the management team just as much they are the product or the service that the underlying company. And so a situation where they would vote in opposition of the team in which they're really investing in is very minimal. And so that's really the driving reason that they don't think this will have a significant impact. They wanted on Friday during our meeting, they wanted me to make sure that you guys know they do take a fiduciary responsibility contractually. So they take that very seriously. And they also, pointed to the 20 and 30-year results as proof that they are very much trying to manage these assets in the sole interest of the beneficiaries and members of the plan, and that would include proxy voting as well. With that, that's really all the comments I have. I included the April 2025 market commentary, just given the time that we find ourselves in. I found it interesting. They speak a lot to their desire, to be long-term business owners and to largely avoid the noise that we're all dealing with in our current environment. But happy to answer any questions if you have any.
Senator Funky Fromeyer has a question.
Thank you, Beau. Glad that this was a positive update based on the market glitch a couple weeks back. So on page 2, or on your slide 2, your 1 year, I'm not sure if I'm following that accurately. And it indicates the cash balance. Is that a rate of return?
Yeah. So we actually manage. So it's a little interesting. It's a great question. When the cash balance plans were created for us in 2014, all of the contributions that are being paid in by those members are actually being accounted for separately. So we actually have 2 investment portfolios, one of which is the defined benefit or the legacy plan that has, all your pre-2014 membership and contributions, and then the $6.5 million just represents contributions received since 2014 for those members in the cash balance plan. And so you can see as you move to the farther right, like the 5-year number is quite a bit different than the 3-year number and the 1-year number. And that's mostly due to the fact for the first several years, these accounts, they didn't have enough assets to own 25 stocks, right? So what we did for the first couple of years is they owned what are called exchange traded funds, or ETFs. And so they tried to get exposure to the S&P 500 there. A little over 3 years ago, the pool of assets had grown large enough that the board decided to fully invest those, and that's why you see the 1 and 3 year numbers are almost identical. But those are actually 2 separate funds from an accounting perspective. So that's a good question.
That makes perfect
Yeah,
sense.
that's a great
Thank you.
question.
I actually wanted to know where they're investing cash to get a 12.3% return, but
No.
I understand now.
No.
Thank you.
Senator Wilson.
Thank you, Mr. Chairman. Beau, thank you for your presentation today. It's always good to hear positive information. Of course, we saw a lot of volatility in the market, and it's kind of good they addressed that, the stock market corrections. And, I've heard for years we're due for those kind of things, and they said over 75 years there's been quite a few stock market corrections, and so it's kind of good to see that information. But I'm curious what is the percentage funding of the plan right now as it stands, and how many members do we have drawing, if you know?
Yeah, if you'll give me 1 second. I actually just had this on we're about 500 and something on the JRP side, recipients.
Okay.
LRP is probably closer to about 300, so it's a little smaller. Both plans as of 2023, so we do full funding valuations every other year. So our most recent was in 2023. All 4 of the plans, pension and insurance, JRP and LRP, had exceeded the 100% funding level. JRP was just slightly over. LRP was a little bit better on the pension side. Of course, we'll have new valuations conducted after the close of this current fiscal year leading up to the biennial budget. But I don't expect the plans to funding to decline dramatically, if any, mostly due to the returns, right? We're still smoothing returns from the last couple of years. And then, as of now, the current quarter is very much in air, but our 1 year is still at 12. So hopefully we'll be somewhere near that 6.5% assumption. And so you would be smoothing in another, positive year. I know we presented membership data back in October of last year. And so I know if you wanted to go, I actually referenced that presentation quite a bit with folks that ask questions about membership, especially between the cash balance and the legacy plan. We're still a little overweight legacy members on JRP. It's kind of 3-to-1 legacy to cash balance, whereas LRP is the opposite. And it's mostly due to the fact that, terms are shorter relative to your judges.
Thank you.
The other thing I would just make a point of, we always put all of our board materials on the website. You spoke to the drawdowns. I wish if I had known, I would have included it. Baird had a really interesting chart in their quarterly update from Friday, where they showed every year there's been a significant drawdown. Now it might be 2%, but for instance, in 1987 there was a 34% drawdown, but the year ended up 2%. And so it was a way for them to. What they were really trying to get at is a lot of times on these drawdowns they're accelerated and they generally overcorrect. And they were just talking about how the emotionality comes into play. And a lot of us, we look at a statement and we want to get out, right? But in a lot of those cases where you have these significant drawdowns, whether it's 30% or 10%, when you look at the calendar year result, there's always, in many of those cases, it's ended positive. And so I just when you made a good comment about the drawdowns, and Baird always says markets are always uncertain and the future is always uncertain. We just don't always recognize it. And currently we're living in an environment where we recognize that the future is uncertain, but it doesn't really change the fact that it's uncertain regardless of whether we recognize it or not. No one knows what tomorrow is going to bring.
I'm seeing no further questions. Beau, thank you for being here today. Appreciate your work.
Thanks for having me.
Next up, the Executive Director of Kentucky Pension Authority, Ryan Barrow, KPPA. Ryan, make yourself at home out there, and when you're ready, introduce yourself for the record and your guest, and please proceed.
Yes, Ryan Barrow, KPPA.
Hi, I'm Erin Surratt. I'm the Executive Director of the Office of Benefits at KPPA.
Well, we're going to follow the same agenda, start with the investments. Obviously, there's a lot of volatility in the market recently that's been driven by, terms like tariffs and sanctions, et cetera. We had a positive quarter, although it is off of the long-term benchmarks. If you look, fiscal year to date is more representative of the last year's reporting as of March 31st, 3 quarters. So we have positive performance in the 5 range. But I would draw your attention, as Beau said, you kind of go to the right of the graph, and we do have positive performance in the 5-year that exceeds the discount factor. So that positive performance again helps with the funding. We've included the insurance, some of the same story here. Positive quarter performance, but fiscal year to date is more representative of the funds over the last 3 quarters. And similar story, although not in every single period on the 5-year out, but they most exceed that key benchmark. So at the last meeting, I look back at the presentation, and at that time we were talking about recent action of the board to change asset allocation. Asset allocation is the most correlative to performance. That really results in the most correlative to performance. And there were 2 recent changes. Both the C and the K made those changes. Happy to report today that those migrations, you don't essentially sell assets and buy in a different class immediately. It's a process. It takes some time. And both of those have been completed, and we are all at or within all of our ranges for the asset allocation. So that's a big kudos to the investment team that have made that change, based on various studies and over time methodically changed those allocations. So flip into the cash flow slide. Much like the previous presentation, there is essentially negative or at zero cash flow. My eye goes to the net flows both kind of in the middle of the slide and then at the bottom without investment income. I will draw your attention on the K non-HAS, the $225 million appropriation. That obviously had a large impact, and you could see that flow to the bottom. And really the result of most of the positive cash flow in that plan is related to that additional contribution. Thank you, by the way. The hazardous, again, has essentially a negative cash flow. And really what the driver is there is what I just spoke to on the investment side. Positive performance, but not necessarily at our target metrics, the discount factor. State police, and then moving over to the C side, we do have negative cash flow for the fiscal year of 25 in both the HAS and non-hazardous plans. I included the insurance in here as well, just for your reference. A lot of the same story, absent the additional contribution. So wrapping up, we wanted to kind of give the legislative update. Aaron's going to cover House Bill 30. So one of the two that we had asked for this year did pass on the pension spiking. And then we are going to move to the Senate Bill 10 and 183, similar to what Beau talked about on 183.
Okay, thank you. We'll talk about House Bill 30 first. And I apologize, the allergies hit me this weekend, so my voice is not great today, and I apologize for that. But House Bill 30 was the pension spiking bill. This bill was also introduced in the 2024 regular session. Identical language in the 2025 session. There was an amendment added that gave some employee benefits that didn't impact the retirement systems to that. But essentially what this does is, due to a Court of Appeal ruling, it's amended the definition of bona fide promotion or career advancement to say that increases in credible compensation given to all employees of a specified class shall be excluded from the pension spiking calculation. Those are commonly referred to, you'll probably hear, as across-the-board raises. So those are excluded from the pension spiking calculation, and we do appreciate this bill being passed this time around to codify that. This also does apply to all of the members and all of the systems administered by KPPA, so CERS, KERS, and SPRS. And then the next bill we'll talk about is Senate Bill 10. This is a bill that increased the health insurance subsidy for CERS members only. This applies to CERS members who are eligible for the dollar contribution health insurance subsidy. The bill states that effective January 1st, 2026, it will increase the non-Medicare dollar contribution amount for CERS members who attain career threshold. Career threshold is defined for hazardous Tier 1 members as 20 years of service. If the CERS hazardous members in Tier 1 reach the 20 years of service, their benefit amount will increase to $50 per month per year of service that they retire with. It's currently, in statute, it's $15. It increases by 1.5% each year, so the dollar amount is about $21.94 right now, but that will increase to $50. For hazardous members in Tier 2 and Tier 3, they must attain 25 years of service credit, and again, it increases to the $50. For in non-hazardous, for all of the tiers, the career threshold is 27 years of service, and their contribution amount would increase to $40 per month per year of service. And then the other change that effective July 1st, 2026, it extends and adjusts the employee non-refundable health insurance contribution, what we call HIC. It's an employee contribution. CERS, again, just CERS, Tier 1 members with a participation date of July 1, 2003 through August 31st, 2008, will now start paying HIC. They do not pay that HIC amount today, but they will start paying that effective July 1st, 2026. And then it increases the hazardous HIC rate from 1% today to 2% effective July 1st, 2026. And that's, again, for the hazardous CERS members. The non-hazardous HIC rate will remain at 1%, which is what those employees pay today. So that will not change. There was some, and I didn't add it to the slide, but there was some non-codified language that says this body, the Public Pension Oversight Board, shall continue to monitor the actuarial data of CERS retiree health funds and shall, during the 2025 interim, evaluate potential legislative options to adjust the retiree health benefits and costs for those members who are impacted by this.
So I'm going to finish up on our last prepared slide here. I'm not going to reiterate everything Beau said. We would agree with that. Just what I found kind of interesting on, the potential for that economic analysis. Looked in the 2024 report, we had over 5,000 proxy votes, and there was approximately 125 that would be shareholder sponsored. So it would only potentially be a fraction of that would require that economic analysis. I think the key thing for us is our existing voting policies that were approved, I guess, in March of 22, I believe. We don't believe that legislation has any major impact to those voting policies. We are going to review them and just, with the investment staff and attorneys as well, just to make sure. But we don't anticipate major impacts from Senate Bill 183, and we'll incorporate, again, the additional terms, as Beau said, along with the economic analysis if it is applicable. So thank you.
Okay, we do have some questions. Representative Tipton.
Thank you, Mr. Chair, and I do have a question about Senate Bill 10. I know sometimes employees are C members for a while, and then they're K members, and they're C members. How would that impact? What impact would it have on their years of service if they had years of service that were in the K system and they're currently in the C system?
Well, I will say that we're still evaluating all of the bill for implementation purposes, but there is a shared reciprocity between the systems, so which you would add the service together for eligibility purposes. So that will be a piece that we'll certainly consider during our review.
Thank you. Representative Johnson.
Thank you, Mr. Chairman. Also on Senate Bill 10, you described what the dollar amount changes are. Could you, for the record, describe what the net benefit for individual members would be? What the purpose behind these dollar amounts? Is that something that you can discuss here?
I think the purpose was to so that a single coverage premium amount would be covered once the member worked their career threshold. Is that what you were asking?
Yeah. So
okay.
If I understand it, it's taking the out-of-pocket expense out of the members' pockets and putting it through this system. Is that
correct?
A fair way to say
yes.
that? I thought it was worth mentioning for the public.
Good point. Thank you.
Thank you.
Okay. Seeing no further questions. We do have one. Representative Cameo.
Thank you, Mr. Chair. I have just a brief question on House Bill 30. Mm-hmm. Was it retroactive to people? Like I just can't remember if it went back to a period.
It was actually in order to follow the Court of Appeals decision. There was an administrative regulation that was passed by the legislative body that made that effective for retirements dates July 1st, 2024 and after. So we have been implementing that for those retirement dates going forward.
Awesome. Thank you.
Mm-hmm.
Okay. Seeing no further questions, unless you all have anything, thank you so much for your presentation. Next up, Beau Barnes, Deputy Executive Secretary and General Counsel for Teachers Retirement System. Beau, it's good to see you today. So,
You too, sir.
Introduce yourself for the record, and the floor is yours.
Yes. Good afternoon, everyone. Beau Barnes, and as the chair noted, I serve as Deputy Executive Secretary and General Counsel for the Teachers Retirement System. I'm going to cover the same topics that you've heard the other retirement systems cover, and with that, we'll begin. We're starting with investment performance. So these are the investment returns for the retirement annuity trust that pays out the pension, if you will, as of March 31st, 2025. These are on odds and preliminary, but the final numbers ought to be really, really close to the ones I'm going to present today. And I'm going to focus on the bottom row of this table on this slide. On the left, you'll see net. That means these are the returns that are net of fees that are paid to invest these monies. And we'll start on the left-hand side. For the quarter, returns were 0.22%. Fiscal year to date, 4.49%. 1 year, 5.41%. 3 year, 4.96%. I will note in those 3 years, one of those 3 years was a really bad year with double-digit negative returns. 5 year, 11.24%. 10 year, 7.67%. 20 year, 7.3%, and 30 year, 7.95%. I will note, as I always do, that TRS is a long-term investor. We don't get as hung up on shorter periods of time. And as a long-term investor, the returns are doing well. We'll remind the board that our assumed rate of return is 7.1% for the retirement annuity trust. And you can see the returns for the 5 through 30-year periods exceeded the assumed rate of return. Next, same format, but this is for the health insurance trust. And again, we will go to the bottom row and move from left to right. For the quarter, the returns were negative 0.2%. Fiscal year to date, 4.36%. 1 year, 6.01%. 3 year, 5.27%. 5 year, 11.55%. And 10 year, 7.42%. And this is a relatively new fund that we started tracking with shared responsibility, and when retiree health insurance moved from being a pay-as-you-go benefit to a pre-funded benefit. And this fund also has an assumed 7.1% rate of return. Next, we're moving into cash flow. And this first slide represents the retirement annuity trust. A couple of things here. This is going to represent the first 8 months of the fiscal year. So from July 1st of 2024 through February 28th of 2025. We don't have some of the final numbers audited on market value of assets. So that's why we're February 28th. Talking to staff, we don't feel like March 31st would be, a lot different in the trends you would see here. And as I always like to note with our cash flow slides, you can kind of break these down into thirds. The top third represents inflows, cash coming into the system. The middle third represents cash outflows, cash leaving the system. And then the bottom third kind of reflects the sum of what happens as a result of those inflows and outflows. And I'm going to start with these two columns of numbers on the right-hand side of this slide. And I'll begin with the one second to the right here. And we'll start at the top here. And these are cash inflows again. And again, this is for the fiscal year period for 25 from July 1st, 24 through February 28th, 25. And you'll see for that period there that the member contributions were $248,600,000. For the prior 8-month period from July 1st, 2023 through February 28th, 2024, member contributions were $233,800. And I'm going to continue to compare these same month periods. So employer contributions, appropriations for the 25-year period, $970,300,000. For the 24-year period, $806,800,000. Investment income, which is stock dividends and fixed income interest, we had $288,100,000 in 25 for the 25-year period, $275,800,000 for the 24-year period. total cash inflows for the 2025 period, $1,507,000,000. For the 24 period, $1,316,400,000. And those are the total cash inflows. Moving to the middle third of this slide, we have the cash outflows. And of course, the big one here is going to be, of course, benefit payments, and also to some much lesser extent refunds, but mostly benefit payments represented here. And so for the 25 period, we have almost $7 billion in outflows from benefit payments and refunds. For the same 8-month period in 24, we have $1 billion. Almost again, $700 million going out. It's a little bit of an increase, but very slight. We also have in cash outflows administrative expense. For 2025, we see that's $12,200,000 compared to 2024, $11,700,000. So total cash outflows for 2025, $1,700,000,000. For 2024. $1,680,000,000. So slight increase there in between those two time periods. We have negative cash flow, of course, here with this, and there's another line that's very important that tells the rest of the story, as I always like to note. But negative cash flow for the 2025 period, $203,900,000, down from the 2024 period where it was $364,500,000. Next line, of course, is very important because it does tell the rest of the story of what's going on with the investments that we have at TRS. And those are investment gains or losses, realized or unrealized. So this represents sale of assets. You know, when assets are running hot, selling high, we sell high, we buy low. And it also represents just increase in value of assets that are held. So investment gains or losses for 2025, $1,455,000,000, 2024, $1,702,000,000. And then I'm going to concentrate on the final two numbers on the slide are going to be the ones in the column, second column from the right, and those bottom two numbers. That top number, the $26,108,100,000, that's the value of assets in the Retirement Annuity Trust as of July 1st, 2024. The number below it, $27,360,100,000, the value of the assets as of February 28th, 2025. So we see there was an increase of $1.252 billion over the 8-month period for the Retirement Annuity Trust. Here we have a similar slide, but this is for the Health Insurance Trust, same format. So I'm just going to run through those numbers as I did with the previous slide. So starting with the cash inflows at the top, second column from the right. For 2025, $141,900,000 compared to 2024, $135,800,000. Employer contributions, $156,700,000 2025, $151,900,000 2024. Recovery income, as I note here, this represents federal subsidies that TRS works hard to collect, as well as prescription formulary rebates that TRS also works hard to collect. $124 million in 2025 compared to $108,600,000 in 2024. And then investment income, $38,400,000 in 25 compared to $32,700,000 in 24. Total cash inflows for 2025, $461 million compared to $429 million for 2024. Moving to cash outflows, again, this is mostly benefits that are being paid out. We see in 2025, $278,400,000 compared to $235,600,000 in 2024. We don't have a number for investment expense. And the reason for that is that our accounting department, we record investment expense as a total expense for the retirement system. And at the end of each fiscal year, then our accounting department goes through the painstaking process of breaking down all the salaries and expenses for health insurance versus those that can be used for the retirement annuity trust or the pension side. So it takes some time, but we do have those numbers broken down for the report that we give after the June 30th of each fiscal year. So net cash flow, and with the health insurance trust, unlike the retirement annuity trust, it is cash flow positive because it's being so well funded as a result of that 2010 shared responsibility legislation, where active teachers, retired teachers, and school districts all started contributing more. And you can see we're cash flow positive in the 2025 period, and to the tune of $182,600,000 compared to $193,400,000 for 2024. And then we'll move to that next important line: investment gains or losses realized or unrealized. $173,400,000 for 2025, $190,400,000 for 2024. And again, now focusing on those bottom two numbers in the second column from the right, you'll see as of July 1st, 2024, we had $3,317,700,000 in the health insurance trust. By February 28th of this year, it had grown to $3,673,600,000. So about a $356 million increase in the health insurance trust over that 8-month period. Next, we'll proceed to asset allocation for the retirement annuity trust. Again, these numbers are as of February 28th, 2025. This really wouldn't change much at all for March 31st. But anyway, starting on the left of the table here, we will see the description of the asset classes that TRS is invested in. Moving to the first column of percentages to the right of it, we see how much of the TRS assets in the retirement annuity and trust are invested in that particular asset class. Next, we'll see the target. That's kind of the bullseye target we aim for. And then we have the range within which our investment staff, our outside consultant, and our investment committee and board feel comfortable. So just looking at the top asset there, which is U.S. equity, domestic stocks, we see as of February 28th, 2025, we're at 39.8% of our total portfolio in the retirement annuity trust was in U.S. equity. The target is 38, so very close, and the range is 31 to 48%. I'm not going to go over these other asset classes individually, but I will tell you that where we were as of February 28th in all these asset classes, we were well within the range. Moving to the next slide, we see the same format, but for the health insurance trust. And I'll just note here that as with the previous slide representing the retirement annuity trust, where TRS was invested as of February of 2025 in these various asset classes, they were all well within the range that have been approved by investment committee and the board of trustees. Legislative update. I'm just going to touch on a few bills here that were enacted in this recent session. We're going to start with Senate Bill 9. And Senate Bill 9 does a couple of things. First, it amends not a teacher's retirement system statute, but a Department of Education statute concerning benefits, and more specifically concerning benefits primarily in the form of sick leave. That is how it's applied and used in the school districts. And so what this amendment to the sick leave statute does, it does a few things. One, and the first one, does not impact TRS, but I'll let you know what is there, and that is that by July 1st, 2030, school districts are to develop policies for up to 30 days of paid maternity leave. Again, does not affect the retirement system. The second one does here. So one of the provisions of this Department of Education statute, and it's KRS 161-155, it allows school districts, doesn't require them, but it allows school districts to compensate their retiring teachers for their unused sick days at up to 30% of their daily rate. And then the statute requires that that lump sum payment be reported to TRS and included as what we call salary credit for inclusion in their retiring member's final average salary for retirement calculation purposes, which has the effect of increasing their retirement allowance somewhat, and that's in place there. Now the state, the Commonwealth, pays by statute for the actuarial cost of that application of sick leave for retirement salary credit. And what Senate Bill 9 does, it's going to change that a little bit. The Commonwealth would still pay the actuarial cost of the sick leave accrued through June 30th, 2024. You know, sick leave being used as salary credit, okay? But prospectively, from July 1st forward, Senate Bill 9 would limit somewhat how much the Commonwealth would pay of the actuarial cost towards this application of sick leave for retirement salary credit. And specifically, the Commonwealth will pay up to 13 days per year of sick leave awarded to teachers. And it would not pay anything above 13 days, nor will the Commonwealth pay for any annual leave days that are rolled over into sick leave. Any sick leave days exceeding 13 days, any annual leave days that are rolled over, the actuarial cost of those days, prospectively from July 1st forward, would be the responsibility of the school district. I'll note here, this is important just so we all, as a refresher, but only school districts and educational co-ops are permitted to compensate their retiring TRS members for their unused sick leave as what we call salary credit, where it is used in the final average salary for retirement calculation purposes. Just to avoid confusion and to kind of point this out, our other employers that can't do that, cannot compensate their retiring TRS members for their unused sick leave as salary credit. There is another statute, which is a TRS statute, and it allows those other employers, like state agencies, to pay the actuarial cost of their retiring TRS members, not for salary credit, but for their unused sick leave as service credit. An example of that would be if someone was retiring with 30 years of work service, they have 100 unused sick leave days. If that employer decides that they want to pay the actuarial cost of that sick leave, that retiring member will now be retiring not with 30 years, but 30 years and 100 days. Very importantly, the employer, not the Commonwealth, has to pay for that cost. There's also in Senate Bill 9, there's some additional sick leave reporting requirements for districts to TRS, including beginning balance of sick leave days every year, sick leave days accrued during the year, and sick leave days used during the year. There's also, for the first time in law, a requirement that school districts provide TRS with their sick leave policies that they have adopted and to keep those policies current. The second part of Senate Bill 9 got passed out of the Senate and was amended in the House to add the TRS housekeeping bill. And the housekeeping bill provided purely technical amendments. It adds a little more detail to the statutes. It does not change the way that anything is done at TRS, any practice or procedure, so purely technical. The next bill I'm going to cover is House Bill 694. I'm going to back up here just a little bit as a reminder again about health insurance and how it's funded. Before 2010, as most people on this board I think realize and know, retired teacher health insurance was paid for on a pay-as-you-go basis. We had dollars in, dollars out. That was unsustainable. The Commonwealth was paying most of that cost voluntarily because there's no inviolable contract guarantee for health insurance except for access to group coverage. But the amount the retiree pays and the levels of coverage can change depending on the funding to pay for it. So anyway, as a result of that really historic 2010 shared responsibility legislation, active teachers began paying more into this health insurance trust, and school districts and retired teachers started paying for the first time money into the health insurance trust. And that has worked wonderfully. We've moved that retired teacher health insurance benefit, that critically important benefit, from a pay-as-you-go benefit to one that's being pre-funded. So a great thing. In that original 2010 legislation, there was some language that when the health insurance trust became sufficiently funded as determined by the retirement system's actuary, that actuary could recommend to the General Assembly to take further action by reducing, eliminating, or suspending those new contributions that were coming in. So House Bill 695 changes those things in a few ways, and I'm going to go over those just very briefly. First, House Bill 694 provides that once the health insurance trust is at least 100% funded, certain employer contributions that are going to the health insurance trust will be reallocated to the retirement annuity trust that pays the pension instead. And specifically, those employer contributions out of the fixed statutory employer contribution that goes to TRS, 0.75% of that, that once the health insurance trust is 100% funded, 0.75% of that that's paid, primarily by the Commonwealth, that will go from the health insurance trust to the retirement annuity trust. There's also some shared responsibility contributions paid by the universities, 2.275% of their payroll for their members who became members before 2022, 2.0% for those who became members after 2022. Those would go from the health insurance trust to the retirement annuity trust. And then also school districts and other employers that are paying 3% of their members' pay towards the health insurance trust, that 3% would also move to the retirement annuity trust. And those contributions would continue to the retirement annuity trust unless the funding in the health insurance trust dropped below 95%. Then they'd have to go back to the health insurance trust. But otherwise, those contributions would continue to the retirement annuity trust until both the retirement annuity trust and the health insurance trust reach 100% funding. Additionally, a change in House Bill 694 is that employee contributions to the health insurance trust, they will continue, okay? But now they will continue until both the retirement annuity trust and the health insurance trust reach 100% funding levels. The next bill I'm going to talk about is House Bill 441. It addresses some or amends some of the TRS retire return to work changes or statutes. You know how teachers can retire and then return to work later on in an active position. And it did this in several ways. The first is we have what we call our standard full-time program that teachers can go into, in which not only do they have to have a break in service between retirement and going back to work for a TRS employer, they are also subject to a daily wage limitation that we call the daily wage threshold. And currently there was a cap on the number of positions statewide of retired teachers who could go back into full-time positions compared to non-retired full-time teachers in the district of 3%. That cap is raised from 3% to 10%. There's also amendment of the critical, what's called the critical shortage program. And the critical shortage program allows school districts to hire a limited number of retirees into these critical shortage positions without being subject to that daily wage threshold. And those limitations have been increased with House Bill 441 from 1% to 10%, or a minimum of 2 retirees per school district to 10. So those are increased. Also, there is a removal of the requirement that the district have to certify that there's no other qualified applicant before hiring a retiree. And then lastly, House Bill 441 would repeal what we call the waiver program. And the waiver program, it's not used by very many people. We had about 65, 68 people in it last time I looked. It allows individuals who retire and then decide they want to go back to work. They can waive their retirement allowance, and if they do that for at least 1 year, then they can later re-retire whenever that is, and they can increase that original retirement allowance with additional service credit and any additional salary credit they might earn as a returning retiree under the waiver program. And then lastly, I'll just note that Senate Bill 183, which has been discussed previously, it's about fiduciary duty and proxy voting. I'll just note that this bill is consistent with the TRS approach to investments, including its proxy votes. It does provide additional detail, but it is consistent the way we approach investments. TRS invests and has always only invested for pecuniary reasons. It never invests for non-pecuniary reasons like environmental, social, or governance issues, ESG. So look forward to implementing that bill as well and following its directive. So that concludes my presentation. If there's any questions about any of this or anything else, I'd be more than happy to take those now.
Representative Tipton has a question.
Mr. Chairman, Beau, good to see you. On the Health Insurance Trust Fund, once it gets to 100%, what's the percentage cost it takes to keep that fund viable?
Oh, it drops dramatically, and I don't have an updated number, but it seems like it was 2 to 3%.
I'm wanting to think 2% is the number
I'm
I
saying
had in
2
mind.
to 3, maybe a little over 2%, but in the 2 to 3% range. Yes, sir.
But once it's fully funded, it does not take near as much as we've been having to put in.
That's correct, sir.
Okay, thank you.
Senator Funky Fromeyer.
Thank you, Beau. My glasses arrived just in time. So as I was looking at the health insurance trust on, and I apologize, I don't see a number on the slide to point you to, but the ending period for 2025 said 3.6 billion, and it showed investment gains of 173 million. But that's down from 2024. So I was a little surprised because it looks like we've got about 500 million more invested. So I'm a little thrown off.
Yeah, so the Retirement Annuity Trust and the Health Insurance Trust are invested in different, slightly different asset allocations, and that's what you see reflected here. There might be, and I probably need to double check this before actually saying it because I might say the wrong thing, but I think I know the asset class that is responsible we're a little more overweight in the health insurance trust. That would have been a drag on that, but
Yeah, from one year to the next like that.
it's every year, some asset classes are in favor and some aren't. And
right.
for this year, that asset class was not.
Yeah. Yeah, thank you.
Thank you. Beau, I thank you for your explanation on the annual leave and service credit.
Yes, sir.
Hopefully we can get together, and I'd like to better understand that. I think there's still some confusion how that works between the cabinets, and I was excited. I always comment on cash flow, and I was excited to see that it was down, but then I noticed that it was down 161 million, but what the General Assembly gave you, I guess that's employer contributions, was up 164 million. So
yes,
it's pretty much a wash.
Yes, sir. Largely that reflects the additional contributions receiving to help address the unfunded liability of the system. Yes, sir.
Well,
and we certainly, the retirement system and Kentucky's teachers, active and retired, are very appreciative of that funding.
Well, we've kept that commitment, but it's been
yes, sir.
It's and that lift gets a little heavier every year. As we've talked about. So we thank you. Any other questions? Okay, we've got one. Okay.
Yeah.
Who's got?
Thank you, Mr. Chairman.
Yes, go please.
Beau, can you mentioned in the recovery income for the health insurance trust $124 million. And you said that was from collection of PBM rebates. And can you just tell us generally what that process involves? What do you all have to do you said you were acting diligently to collect those rebates. And I'm wondering, what cooperation do you get from the PBM companies and why do you have to go through that process?
The PBMs are instrumental and vital in being able to determine what those rebates are, make sure that that they're getting all the rebates that we can, and then auditing that process all along the way to make sure that what we're getting is what we're supposed to getting. That's something that is so complex. We have about 100 full-time members at TRS. That's retirement counselors, that's our health insurance staff, investments, accounting, and our information technology department. that's something that would really be impossible for us to do on our own, unless we were to double our staff size. But they have the economies of scale and the efficiency to be able to track those rebates for us, make sure we're filing our claims for those rebates, and making sure that, we get those rebates audited to make sure we get what we're getting. If we need to do an over-under, we will.
Okay, and who is it that does that for you?
That's Express Scripts.
Okay, but isn't that's the PBM company, right?
Yes, sir.
Okay, so just my basic question is, do you understand that they are cooperating with you in that process?
Yes.
Okay.
They do, and they're contractually obliged to as well. Thank you. Good question.
Victor, I'm sorry I had a senior moment there. Couldn't come up with the name. Beau, one final question. I don't see anybody else with their hand up, but under the Inflation Reduction Act, there was a lot done with the Medicare Advantage plans, and I've heard some stories about some of those plans having some fairly healthy increases. Do you see anything, or do you use the Advantage Medicare plan?
Yes. So the one aspect of that federal legislation was that the out-of-pocket for prescription drugs declined from our current $8,000 to $2,000. Now, that has some impact, but it doesn't impact all of our members. In fact, it impacts a smaller number of our members. But for those individuals, yes, cost will go up, and be glad to get you some current numbers on that if you'd like.
I guess really what I want to know, and you can give it to us sometime, but is there a panic? Is there anything that, are we going to see any drastic increases, I guess is what I'm...
No, sir. From what the preliminary numbers I saw, it looks like it's going to be very manageable.
Okay. Thank you. Seeing no further questions. Thank you, Beau. Appreciate you being here, and I'm glad we got your housekeeping bill passed.
Yes.
I think it.
Yes.
I have to thank the House for getting that worked in for you.
Oh,
and
thank you, sir, and thank you, Co-Chair Thomas, as well. Appreciate your work on that. Really do. It does a lot of good things, and we're very appreciative of that.
Good. I would entertain if no further business, entertain a motion to adjourn.
Move for adjournment.
So moved. We are adjourned.